The Gemini crypto exchange just realized that they left $70 million on the table because of a grudge. Now that is the claim that is coming straight from the founder of Cardano. And when you look at the math, it actually gets worse. Now you've probably seen the headlines about exchange listings before, but this one isn't just about a new button appearing on an application. This is a story about ego, institutional gatekeeping, and a massive financial miscalculation that cost one of the biggest names in crypto a literal fortune. You have to wonder what goes on behind the closed doors of a multi-billion-dollar exchange. Now, we like to think that these companies are just run by cold, calculating machines that only really care about the profit, right? If there's money to be made, then they're going to make it. At least that's what we tell ourselves. Well, the situation between Gemini and Cardano actually proves that that isn't always the case. You see, for years, the Gemini crypto exchange, the exchange that is run by the Winklevoss twins, they simply refused to list ADA. It didn't really matter what Cardano was, or didn't really matter that Cardano was consistently a top 10 cryptocurrency. It didn't really matter that the community was one of the loudest and most loyal in the space. No, the door just simply stayed locked. So the question was, why? Right? If they were running a business and a product came along that millions of people wanted to buy, then you would stock it on your shelves, right? That's just basic commerce. Yet, for nearly 5 years, Gemini acted like Cardano did not even exist. Now, Charles Hoskinson is taking a victory lap here, and he's bringing the receipts with him. Now, he's pointing out that by the time that Gemini finally decided to join the party in late 2025, that they had already missed out on $70 million in potential revenue. That is a staggering amount of money to lose just to prove a point. I mean, think about what $70 million actually looks like. That's not just missed profit. That's enough to fund an entire department, pay for massive legal defenses, or whatever a bear market might throw at you. Now, for Gemini, a company that has faced its fair share of regulatory hurdles and liquidity scares over the last few years, that money wasn't just pocket change. It would have been a lifeline that they chose to cut out. Now, we need to understand how we got to this point then. To do that, we have to look at two very different worlds that these players actually live in. You see, on one side, you have the Winklevoss twins, the face of the regulated and institutional crypto, right? They come from the world of Harvard, Olympic rowing, and Facebook lawsuits. They built Gemini to be the clean exchange, the one that follows every rule to the letter. They, at least on the other side of that, you actually have Charles Hoskinson and Cardano, a project that was built on peer-reviewed research, academic rigor, and a slow and steady approach that often rubs the move fast and break things crowd the wrong way. To truly understand why Gemini sat on the sidelines for so long, we have to look back to the very early days of the industry. The relationship between Charles Hoskinson and the establishment of crypto has always been a rocky one. I mean, remember, Charles was one of the original founders of Ethereum. Now, he left that project after a fundamental disagreement about whether it should be a non-profit or a commercial entity. Now, since then, he's been building Cardano as a direct rival, often taking public swipes at the way that other projects are run. Now, the Winklevoss twins, meanwhile, were positioning Gemini as the kind of Wall Street of crypto. They wanted to be the ones that the SEC actually liked. They wanted to be the adults in the room. Now, in their eyes, Cardano, with its complex peer-reviewed process and its vocal, sometimes aggressive community, it didn't fit the image that they were trying to project. Now, there were rumors that the friction between Charles and the twins dates back to the very early industry conferences where their vastly different philosophies first clashed. Charles is the mathematician philosopher who wants to bank the unbanked in Africa. The twins are the institutional players who want to bridge the gap to traditional finance. Now those two visions, they don't always play nice together. But in business, personal feelings are supposed to kind of take a back seat to the balance sheet. Now for nearly half a decade, Gemini watched as Cardano grew from a, let's say it, ghost chain to a multi-billion-dollar ecosystem. They watched as Cardano launched smart contracts with the Alonzo upgrade. They watched as the Vasil fork improved scalability. And through it all, they said nothing. They didn't list it. They didn't talk about it. They simply ignored it. For a long time, Gemini used technical difficulty as a shield. They claimed that Cardano was just too hard to integrate. And to be fair, they aren't entirely lying. I mean, most of the crypto world, Ethereum, Binance Smart Chain, Polygon, they use what is called an account-based model. It's very similar to how your bank account would work. Like you have a balance, and when you send some money, that balance goes down and someone else's goes up. But Cardano, it is different. It uses something that is called the EU Txi model, which is actually a cousin to how Bitcoin works. So instead of a single balance, your wallet is made up of a whole bunch of different kind of unspent outputs. Now, imagine that your wallet isn't full of a single digital number, right? But actually a collection of different bits and coins of various different sizes. Now, when you want to buy something, you actually have to pick the right bills to actually equal the amount that you want, and you get change that comes back. Now, for an exchange, that was built to kind of handle account-based systems, building the kind of infrastructure to handle the EU Txi is kind of an awful lot of work. It requires writing entirely new libraries, new security protocols, and new wallet management systems. Gemini's team likely looked at the work required and simply said, it probably isn't worth it. But here is the problem with that excuse. Every other major exchange did it. Coinbase did it, Kraken did it, Binance did it. Even smaller, less funded exchanges figured out how to integrate Cardano. So when Gemini says it was too hard, what they are actually saying is that they didn't care enough to even try. Like they were simply willing to sacrifice $70 million in revenue just so that they wouldn't have to hire a few more engineers to tackle the Cardano problem. Let's talk about the $70 million figure. Now, this isn't just a number that Charles has, pulled from thin air. It's actually based on the trading volume and staking fees that Cardano generated during the peak of its growth. From 2021 to 2024, Cardano was one of the most traded assets in the world. Now, during the massive bull run of 2021, ADA's price went from pennies to nearly $3. The volume was astronomical, and every trade on an exchange like Gemini carries a fee. Usually that is anywhere between 0.1% and 1.5%, depending on the platform, of course. Now, when you multiply all of those fees by billions of dollars in volume over several years, you quickly reach that $70 million mark. But it's not just about the trading fees. Cardano is a proof of stake network too. By most users, they don't just want to run their own staking nodes, they want to keep their ADA on an exchange and let the exchange handle the staking for them. Now, in exchange for this convenience, the exchange usually takes a cut of the staking rewards, often 20 to 25%. Yeah, crazy, I know. But Cardano has one of the highest staking ratios in the industry. Now, for years, more than 60% of all of the ADA in existence has been staked. By not listing ADA, Gemini didn't just miss on the trading fees, they also missed on the massive, reoccurring revenue stream of being a Cardano validator. Now, this is passive income for an exchange. It is the easiest way, at least the easiest money in the world to make for Gemini, and Gemini said, no thanks. We have to look at the financial health of Gemini during this period too, because unlike Coinbase, which is a public company, Gemini is private, so we don't actually see all of their books. But what we do know is that they've had a rough road lately. The collapse of the Genesis lending platform, which was the backbone of Gemini's Earn program, left a $1 billion hole and thousands of angry customers. Now, in a world where Gemini was fighting for its life, why would they ignore a $70 million revenue opportunity? This is the big breakdown of their strategy here, because it reveals that an organization had become kind of rigid and out of touch. They were so focused on being the regulated choice that they forgot that they were also a business. Now, they also failed to realize that by not listing ADA, they were driving their most loyal customers away, right? If you were a Gemini user in 2021 and you wanted to buy Cardano, you didn't just decide not to buy it, right? You would open up a Coinbase account, maybe a Binance account, maybe a Kraken account, and once you've moved your money over to, let's say, Coinbase to buy ADA, you probably stayed over there to buy your Bitcoin, your Ethereum, and your XRP too. You see, Gemini's stubbornness, it wasn't just a loss of fees, it was a loss of market share. They effectively funded the growth of their competitors by refusing to give their customers what they wanted. This is a classic case of institutional arrogance leading to financial decay. For years, exchanges held all of the power. If you were a new crypto project, then you had to beg for a listing. You had to pay listing fees that could reach into the millions of dollars. You had to provide marketing support and liquidity on top. Now, the exchanges were the king makers. Now, Charles Hoskinson changed that game completely. He famously refused to pay listing fees. He argued that if an exchange wanted to make some money off of his community, then they should be the ones doing all of the work to list it. It was a bold move that many thought would fail. Critics said that Cardano would die if it wasn't on the big exchanges. But the opposite happened. The community became so large and so active that the exchanges eventually had to come to Cardano. They realized that by not listing ADA, they were the ones that were losing out. One by one, the dominoes fell. Coinbase listed it in March of 2021, and others followed. Gemini was the last major holdout in the US market. Now, this victory, by the Cardano community, it proves that the decentralization isn't just a technical feature, it is also an economic one. You see, when a project is truly decentralized and has enough of a global user base, no single gatekeeper can kill it. Gemini tried to ignore the gravity of Cardano, and all they did was get pulled into its orbit eventually, but only after they'd already burned through all of their fuel. Now, I do have to just pause here for a second to let you know that I'm not a financial advisor. This video today is for entertainment and for educational purposes. Now, you probably noticed the crypto market is kind of volatile. Now, you could genuinely lose everything that you've invested. That's why it's really important that you do your own research and consult a qualified professional, because your money is your responsibility. Now, if you are watching this and you are thinking to yourself, how do I actually keep track of all of these movements before they become these headlines? You should probably join our educational Discord. It's a community of people who are looking at these assets in real time, away from the noise of the official announcements. And if you want to be moving beyond just watching and actually starting to master the mechanics of all of these markets and how they work, then head over to 𝗗𝗶𝘀𝗰, because we have structured courses designed to take you from a spectator to someone who actually understands the why behind the what. Okay. Let's get back to the breakdown here, because while $17 million is an awful lot of money, the damage to Gemini's reputation might be even more expensive. Why do smart people make such dumb financial decisions? It happens when an organization becomes an echo chamber. Now, if everyone at the top of Gemini was convinced that Cardano was vaporware or too academic, well, they would ignore any data that suggested otherwise. Now, they would see the $70 million as bad money or not worth the risk. even as their competitors were laughing all the way to the bank. You see, this institutional blind spot is kind of dangerous. Now, we saw it with the big banks in 2008, and we're seeing it now with the regulated crypto exchanges. They get so focused on their internal metrics and their reputations and relationships with the regulators that they actually lose touch of what actual users want. Now you, the viewer, are the one who suffers in this scenario. If you were a Gemini user who wanted to hold ADA, you were forced to use a different platform. You had to manage multiple different logins, multiple 2FA codes, and multiple different tax reports, all because of a single exchange that decided that your preferred asset didn't fit their vibe. Now, this is the kind of big breakdown of the exchange model. Now, we rely on these platforms to be our windows into the crypto world. But sometimes those windows are kind of tinted, right? They only let you see what they want you to see. But the market is a global market. It runs 24/7. It is a 24/7 machine. It doesn't really care about Gemini's listing committee. No actual decentralized project does. It only cares about the liquidity and the demand. So, what changed? Why did Gemini finally list ADA at the end of 2025? It wasn't because Cardano suddenly changed its code or because Charles Hoskinson sent them a sorry card. It happened because the financial pressure became impossible to ignore. See, when you are facing $70 million hole in your potential earnings, eventually the philosophy has to give way to the survival, and Gemini has been through a rough couple of years so far. Right? Between the kind of fallout of the Genesis, collapse and the constant pressure from the SEC, they needed a win. They needed some new users and they needed volume. Listing ADA was an admission of defeat. It was a silent acknowledgement that their previous stance was wrong. But by the time that they did it, the Cardano summer had already happened. The massive price discovery phases where exchanges were making the most amount of money had already passed. So it's like opening a store that sells umbrellas only after the storm has actually passed. I mean, sure, some people will say still kind of buy them just to be prepared, but you missed the big rush, right? So you missed the moment when you were truly actually needed. Now this pivot, it reeks of desperation rather than a change of heart. And the Cardano community knows it. Let's look at the what if. I mean, what could Gemini have done with an extra $70 million over the last 2 years? I mean, let's think about the earn users who were caught in the Genesis bankruptcy, right? Think about the legal fees spent fighting regulators. $70 million, it doesn't solve every single problem, but it does provide a massive cushion. It gives a company the ability to innovate, to hire the best talent, and to expand into new markets. Instead, that money stayed in the pockets of the Gemini users who moved to Coinbase or somewhere else. It went to the fees paid to Kraken or to Binance. It was a massive redistribution of wealth from one exchange to its rivals, all triggered by a single, stubborn decision. Now this is the butterfly effect in crypto. A single no in a boardroom in New York can lead to a $70 million loss years later. It's a reminder that the industry, or this industry, everything is actually connected. Your listing policy, your social media presence, your technical roadmap all feed into a single bottom line. If one of those is broken, the whole system starts to leak. Now, we also have to consider the impact on the Cardano ecosystem. You see, while ADA didn't need Gemini to survive, having one of the most regulated exchanges in the United States list the asset earlier probably would have provided a lot more normie credibility. Now, it would have made it much easier for financial advisors and institutional players to gain exposure. Gemini holdout, it didn't just hurt Gemini, it was a form of kind of soft censorship for the entire Cardano project. For Charles Hoskinson, this isn't just about the money. It's actually about being right. Now, he spent years being the outsider, right? The guy, the cool kids in the crypto that tried to ignore him, right? To be able to point to a $70 million failure and say, "I told you so," is a level of vindication that very few people actually get. But there is a deeper lesson here for all of us. You see, it's a lesson about the power of decentralization. Cardano survived and thrived for years without the blessing of the Winklevoss twins. It proved that a project with a strong enough community and a solid enough foundation doesn't need to beg any exchange for a seat at the table. Eventually, the table comes to you. Now, this story is a warning to every other exchange and institution that is out there. If you try to fight the market, you will lose. If you try to gatekeep assets that people actually want, they will find another way around you. Right? The era of the all-powerful exchange is ending. We are now moving into a world where liquidity is fluid and users are smarter. Now, the big breakdown of the Gemini Cardano strategy is just the beginning. We are going to be seeing more of these institutional regrets as the kind of old ways of doing business clashes with the reality of the crypto market. The question is, who is next? Which exchange is currently sitting on a no that is going to cost them the next $70 million? As we look at the wreckage of this decision, what can we all take away from this? Well, first, you should probably never underestimate the power of a community. The Cardano army, they stayed loyal even when the biggest platforms ignored them. They built their own decentralized exchanges, their own wallets, and their own ecosystem. They didn't wait for anyone's permission. Second, ego is the biggest hidden fee in finance. Whether you are a trader or even a billionaire exchange owner, if you let your personal feelings dictate your financial decisions, you are going to pay for it. Gemini paid $70 million for their ego. That is an expensive lesson. Finally, the crypto market is a great equalizer. It doesn't really care about your Harvard degree or your Olympic medals. It only cares about what you bring to the table today. Now, Gemini, they tried to play by the old rules in a new world, and they got burned for it. Now, if you are watching this, then you are already ahead of the game. You are looking for the stories behind the numbers. You are trying to understand the why. And that is exactly why, or at least what we kind of try to do every single day. Make sure that you are in that Discord. And if you are serious about all of this, then we'll see you over at the Cheeky School as well. Now, the story of the $70 million ghost is a reminder that in crypto, the biggest risks aren't always the coins that you buy. Sometimes the biggest risk is the opportunity that you're too proud to take. Now, Gemini, they finally opened the door, but the room was already empty. Everyone had already moved on to the next big thing. And in this world, once you are left behind, it's a long, expensive walk to catch up. For now though, guys, you can do me a favor by hitting that like button, subscribing to the channel, and checking out the video that is queued up on the screen. I'll catch you all in the next one.